Okay, so we were here, we were discussing arbitrage free valuation. I think it's getting, don't even have that. Or we try to do this. Okay, now that's better. Okay, I'll just briefly clarify one point because I thought Sahil had some discomfort with the point when I said that. Or was it you or one minute? What is the point? You don't even know what point I'm talking about. Before that, you're saying no. Okay, no, I just thought Sahil or somebody else was. When I said that the NPV in the NPV model, okay, is the structure of the model is project cost plus ignoring signs, or you can just write it as your project fair value minus project cost. Okay, so project market price. So fair value versus market price. You just write it like this. Okay, so this is the correct formulation of the NPV model. Now some people may get confused because they're saying that this fair value component also has to be determined. Okay, so the correct way to think about this is actually to say that the NPV model, remember, even such a simple thing is actually, even such a simple equation is a model. If you just write NPV as project fair value minus project cost, that's also a model. Okay, that's why, so a model doesn't have to be like overcomplicated with 20 simultaneous equations. Even this is a model because it fits the basic definition. What is the definition? Chada? How do we define a mathematical model? Everyone has forgotten? You are doing so much.
Relationship between variables.
Yeah, so it defines a specific mathematical relationship between inputs and outputs. A set of inputs and a set of outputs. Okay, simple definition. You must have the theoretical concept in your head clear. Okay, so that you can, otherwise some people might have said this is not a model because it's not maybe not complicated enough. Okay, so even this is the model. X is equal to A minus B, that's also a model. Okay, this is clear? Well, people are not in agreement. It's not complicated enough. Does it describe a mathematical relationship between a set of inputs and a set of outputs? Right? Here the set of outputs has only one element and the set of inputs has two elements. Okay? So the way to think about it is that the NPV model is written like this. Now in order to determine one of the inputs to the NPV model, you have to separately run a separate model for the fair value of the project, which is only these terms. Here. Is this clear? You have to separately run a separate model before that, okay, as a preceding step, where you can compute the fair value of the model of the project. Now that is a model for the fair value of the project. In that model, the endogenous variable will be the fair value of the project. Is this clear? Okay, so the output of that particular fair value of the project model, that output will later become an input in the NPV model. Are you following the structure?
Yes, sir.
Ria is not convinced. Are you following? The correct way to think about it is like this. Are you following what I'm trying to say? Okay, that this is the stepwise. This is how you should think about it. Okay, so the output of one model can become the input of another model. Okay, all right. So just wanted to clarify that. Now we'll go back to our discussion on arbitrage free valuation to complete the discussion. Okay, so I have added the Bihar part of the border restrictions. So what we discussed is, we found, first let's understand what we did without any border restrictions, no restrictions on interstate trade. All right, so then what we have is that the fair value, where are all the prices? Okay, 45, 20 and 65. So what we have to do is, so if the question is, what is the actually the question should be rewritten like this. So this is the information given to you, 45, 20 and 75. So the question is, what is the fair value? Okay, the question is actually the more fundamental question is, if you go back to this, which is we are trying to decide whether to buy or sell. Okay, so let's follow stepwise. It's a very simple example, but I'm running it once again through basic steps so that you understand exactly what the framework is. And then even if it's even if you have a much more complicated example in real life, you will be able to follow the same steps. Okay, so the first question that arises is, when you see this information here, whether to buy or sell in the when you're looking at the Delhi sugar price, okay, should you sell or buy? Are you following what I'm doing? Yes. If it's too basic, okay, Maybe it's too basic, but let's just follow along, because we want to make sure that the logical steps are clear in your mind, so that later on when you have a more complicated example, you can use the same logical steps. Are you following?
Yes.
What? People are not nodding aggressively enough.
Yes.
Nikhil, your phone, that's your phone? Okay. All right. So, so the first question is, so basically let's restate the question in this way. Here it's written like this, okay? Let's put it this way. So the question is, okay, question 1 is to buy or sell Delhi sugar, okay? Is this clear? Delhi sugar is the market you're looking at, whether to buy or to sell. We go right from the very basics. Now this is your decision problem, to buy or to sell. Now here let's assume that you don't believe in the value agnostic approach. Now this is a fundamentally subjective decision, okay? Now your choice, let's maybe make this a little bit smaller so you can see the full view of the table and what I'm actually meaning here. Alright, like it's like this, okay? So you have this, and this problem can be solved in 2 basic ways. There's no compulsion for you to choose either way. You choose whatever method makes sense to you. Alright, so in this case we are going to, since we want to discuss AFV, we are going to forcibly assume that the person who has to make this decision whether to buy or to sell Delhi sugar is not a believer in this approach. He does not believe in the TA approach, so he is going to use the value versus price comparison approach. Okay, so in this case you should first check so when you're here, your first goal should be to check whether when you're talking about buy or sell, now you're going to use this method. Okay, now you know that here there are 2 basic approaches within this part of the framework, which is value versus price. You can use either AFV or forecast based valuation. Is this clear?
Yeah.
Okay, now your goal should always be to first check whether an AFV price is available, whether you can determine AFV in this manner, the proper form of AFV, whether actually there is a arbitrage possible. Okay, so this should be your first investigation. So that's what you're doing is now is there. The second question is therefore, okay, and here you reject TA, so that takes you to the FA price straight away. Okay. All right. So the next question is there okay, or is there, let's say is there a true okay, what I mean by this, is there a true AFV? True is I'm using a short form for this. I've given you 2 types of AFV. One is properly so-called, which is really, this is true AFV, and this is actually, you can just call it false AFV for short, because we don't want to use such a big term, improperly so-called. Actually, I borrowed this from John Austin and legal positivism, but we don't need to worry about that. Let's make it false AFV and true AFV. Okay, so now the first question is there a true can we compute a true fair value using AFV? Okay, so here for this what you see is, then what you do is you find out is, the second question is synthetic. Okay, can we devise a synthetic position or fair value? Okay, so synthetic, you already know what a synthetic is. Okay, so this is all sounding a little bit complicated because I'm using the English language. When you look at the actual step, you will see it's very clear. So when you see that up to question 2, is it clear to everyone? You're just trying to figure out whether there is a true arbitrage free valuation price. Okay, whether we can compute a true fair value using AFV. Okay, now what we do is, so the second step is, the second thing you try to think about is, can you construct a synthetic position equivalent to the FEB? Okay, synthetic equivalent to, these are the 2 words which are important, equivalent to Delhi sugar. Okay, so now we are looking at this market, we are looking at this first market, which is the Delhi sugar market. Where is it? Here. We are looking at this market, right? Now we are asking this question of, if we want to see whether true AFB is possible in this situation, okay, what we are going to ask ourselves is, can we create a synthetic equivalent position to a position in Delhi sugar? You can, one of the options you have is that you can buy or sell Delhi sugar directly. Yes or no?
Yes, sir.
You have the option. Why are people dozing off so early in the class? Just pay attention, just be with me for a while, because you need to, I want to make sure that you go, it seems very basic, but I want to make sure that you understand the logical steps, so that in a more complicated situation, you can apply these logical steps. So one option you have is you can buy or sell Delhi sugar at 75. Remember, 75 is the choice price. You remember what choice price is?
Yes, sir.
Yes, Ayush? You remember what choice price is?
Yes, sir.
What is a choice price?
The
If a dollar Swiss market maker is quoting you a price for dollar Swiss, okay, it says 1.2710 choice. What does that mean for you? Is that a bid or an offer? What? It's an offer. Nikhil, remember what we discussed yesterday about choice prices? You've forgotten. So why are you looking at your phone? Who will tell me what a choice price is? Yes.
Sir, buy and sell at same price.
Buy and sell at the same price. So if it quotes you dollar Swiss price, market makers quoting you 127.10, okay, choice. Okay, he will quote it as 1.2710, and he will say CH for choice. Okay, so if the choice price means you can either, that's both bid is equal to offer. Okay, so you can either sell at that price or buy at that price. Okay, so these are all choice prices, 75, 45, 20, these are all choice prices. Okay, so what we are trying to figure out, one option available to you, there are always, in this arbitrage free valuation framework, you're always looking at two alternatives. Okay, you'll be comparing two alternatives. One alternative is to directly do the transaction in the Delhi sugar market. Okay, that is directly buy or sell in Delhi sugar in the Delhi sugar market, which is one option available to you. You can do that. Okay, but you also have access to you also have information on the Patna price. So what you see, what Bola did yesterday was he figured out that it is actually cheaper to get sugar from, if you buy sugar in Patna at 45 rupees and use a shipping cost of 20 rupees, you can actually create a synthetic position in Delhi sugar at 65 rupees. Is this clear? Yeah. Now you understand how the language is used. Okay, so we are talking about a synthetic position. Why? It's not a real position. I mean, it's not a natural position. It's a synthetic position because it's not actually sugar which was originally there in Delhi, but you artificially brought it to Delhi by buying in another location and bringing it here with the shipping cost. So it's a synthetic position, but it is, once you bring it there, it's the same thing. Okay, and let's assume that these are all trading for 14-day forward delivery. Okay, so you have some, we can look at, we don't have to assume instantaneous. So remember transaction dates and settlement dates?
Yes.
Remember that?
Yes.
So transaction date and settlement date will be 14, T plus 14, okay? Settlement is equal to, we'll write it simply as T plus, since you're now all experts in finance, we can write it as T plus 14, which means settlement is 14-day forward. That gives you enough time to ship the sugar. You don't have to make assumptions about instantaneous delivery and all that. Okay, so now, so you have two concepts. You have a natural position in Delhi sugar, and you have now conceptualized a synthetic equivalent position. Okay, the term is synthetic equivalent, that you have to understand. So by buying it in Patna and shipping it across, it's a synthetic equivalent. Okay, so essentially the cost of, so what we say is, can we devise, if the answer is yes, okay, right, then what will happen is, this is not a question, the cost of generating, so here we are just writing down the basic theoretical steps which you can apply to any problem, even a problem with, like I said, this one has only 3 moving parts. Okay, 3 moving parts here, 20 the transportation cost, prices in Patna and Delhi. You may have a bigger problem with 25 moving parts, but you can still apply the same framework. Okay, as long as you know how to create the exact synthetic position. It has to be the same, it has to have the same cash flows, same consequences. Okay, so here, and same here, we are assuming the same grade of sugar. The cost of generating or creating is a better word, creating the synthetic okay, so the cost of creating the synthetic equivalent is let's call it the natural market. The natural market here means I'm just contrasting it with synthetic. Okay, natural market here example is Delhi sugar. Okay, right? So here what we were trying to, so follow the, are you following the logical steps? Okay, you see a normal price, you see a price of 75 rupees for the Delhi sugar market, and you don't know whether this is a price that should make you sell or should make you buy. Is this clear? This is a basic decision problem. All right. Okay, so then what you do is you try to solve this problem using the AFV technique. So which means you immediately start searching around for other market information that you have. In this case, you have information that there's sugar available in Patna for 45 rupees and transportation cost is 20 rupees. And by looking at that information, you can see what you're really trying to see is to try to see if you can create a synthetic equivalent position to Delhi sugar. Okay, so you see that you can create one at 65 rupees. Okay, so therefore the answer is that here the point is that the cost of creating the synthetic equivalent position, okay, is the fair value for the natural market. That is the fair value for the price in Delhi. Okay, you see this price in Delhi is 75. Okay, so you understand what is fair value? Fair value, you understand? Okay, so we are using fair value. This is fair value using AFP principles. Okay, obviously the above, I think I wrote this somewhere else. Okay. Okay, I already wrote this yesterday, so I've written it twice. Okay. Let me just copy it from here. So it may sound a little bit complicated, okay, because I'm using the language, like once again you said I'm using complicated language, but the reason I'm using complicated language is there is certain lingo in finance that you guys have to be familiar with. So the language has to be used in the correct way, like words like synthetic equivalent, okay. When you're talking to people in finance, in the financial markets, you have to use these kind of terms. You can't just use whatever term you want. So that's why I'm making sure, and then you have to use the language in the correct way. Okay, so therefore, because at the end of the day, you're communicating. Okay, so you have to use the right technical terms, and you have to craft the sentence in the right way so that people understand clearly what you're talking about. There's no confusion about what you're saying. Okay, right. Cost of creating the is the fee. Yeah, just nothing much here. Okay, so is anybody finding this confused? I mean, I don't know why everybody has switched off so early in the class. What happened? Tanuj, are you following what is being discussed? Some. Okay, there is a new word that you've devised. Okay, you're making contribution. Oh, why, Tushar, what is happening? Are you following? If you're not following, see, you got to ask me, because this is a basic step. These are theoretical steps that you have to follow for any problem. Okay, so understand this concept. Since we have got into this discussion, I want to at least make sure that people understand how arbitrage pre-valuation is done. Okay, how AFV is done. That's why I'm going from the very beginning so that there's no confusion. Okay, so please make sure that you guys are all following along. Okay, Himani, are you with us? Yes. Why don't you come? Your seat next to you is not usable. Okay, so why don't we bring Himani here? Why don't you come and? No, she's saying the seat doesn't work. It works. Okay, good. Himani, come and sit next to Gunjan. Okay, so let's get everybody up here so that it's only the first class. People are already falling asleep. Okay, so so let's follow the logic once again from the very beginning. Okay. you have a basic decision problem. You see these prices here, these two different markets. You see these prices. As far as the Delhi market is concerned, you are not sure whether you should buy or sell. Okay, let's take it from the very beginning. You have a decision problem. Should I buy it or sell it? Okay, so you have decided to solve this decision problem using this approach. Okay, and here what I'm telling you is always look to see if you can create a true AFB price. Is there a true AFB price that is available in the market that can be created? Okay, so what you're trying to see is if is there a true opportunity for let's put it this way, is there a true opportunity for is there a true fair value using AFB? Later on we'll redefine this a little more clearly. So this is your question. Now how do you calculate that? How do you sort of answer that question? Is there a true fair value using AFB? Straight away the simple rule is look for synthetic equivalents. Okay, look for market prices around you, whatever market you can access. Okay, is there a synthetic equivalent? You look around and you see that there is one, because you can buy the sugar in Patna and ship it off to Delhi, and that will create the same result, because once you get the sugar in Delhi, it's the same grade of sugar and it is indistinguishable from sugar that is bought in Delhi. This is clear? So it's a synthetic equivalent. It's synthetic because it was not originally there. You brought it here artificially. Is this clear? Okay. Now you find, so then what we are saying is the rule is that, yeah, where's the question? Yeah, can we devise? Yeah. So now the rule is essentially the cost of creating the synthetic equivalent. What is the cost of creating the synthetic equivalent?
65.
65. The cost of creating the synthetic equivalent is 65. Does everyone agree?
Yes, sir.
Okay. So that is whatever is the cost of creating the synthetic equivalent, remember it has to be equivalent. Equivalent word is very important. It has to have the same effect. Okay. If you get it only to Ghaziabad, that's not equivalent. Okay. You have to bring it to the same location. So then, so now it's a synthetic equivalent. So the cost of creating, so the principle of AFB essentially is, so try to understand because AFB is, after all, it stands for arbitrage free valuation. It is a valuation principle. Just like when you do this kind of forecast based valuation of a project, the valuation principle is that the fair value of the project is equal to the PV of the sum of the PVs of all the future cash flows. Okay, that is the principle that you're using. That's why you write that equation and compute the value of that equation, right? That is the principle that you're using. So here the principle is that the cost of creating the synthetic equivalent is the fair value for the natural market. Natural market here is Delhi sugar. Okay, so this is not a very elegant term, natural market, but I've used it to contrast it with the synthetic market. I'm contrasting it with synthetic, so I'm using the word natural. Okay, so in this case the natural market is Delhi sugar. So the fair value, the above fair value is the fair value using AFB principles. Okay, this is where I'm using the language. You have to understand the language also. Okay, so this fair value that you computed, so what we are saying is, we are saying two things. We are saying the cost of creating the synthetic equivalent is the fair value for the natural market, which is the Delhi sugar market. Okay, the fair value for sugar in the Delhi market. Okay, and how did I compute this fair value? I computed this fair value using AFB principles. Is this clear? Okay, this is how you should talk about it. Okay, I computed this fair value using AFB principles. Just like when I gave you the example, when you compute the value of a project, you use a certain principle. That is, the value of the project is equal to the sum of the NPVs of all the things, right? Okay, all right. Okay, so so this much, this clear. Okay, the above FB is the fair value using AFB principles of Delhi sugar. Okay, does anybody have any confusion at this stage? Please let me know. That we should make sure that everybody understands this. This is a very important principle in finance, how to do arbitrage free valuation. Okay, so the key word here is the synthetic equivalent concept. Okay, and the cost of the synthetic equivalent becomes the fair value of the natural market. Okay, is that clear? This is the basic simple principle. So you can apply it, no matter, the same principle will apply no matter how complicated the situation. You may have options, swaps, this, that, all kinds of complicated instruments, but the basic logic is always the same. Because you might have 27 different instruments, it will take you longer to compute the cost of creating the synthetic equivalent, but the basic process will not change. So it's clear to everyone? Okay, so what we are saying is arbitrage free. We have already written these steps here. Doesn't matter. I'll clean up the notes later on. Yeah, this is fine. calculate fair value using AFV, compare. Now we are coming back. So now that we have found we have still not completed the whole series of steps. Okay, so we computed the fair value using AFV principles. Now we come to the next step. So we got this, calculate the fair value using AFV. Now we are going to compare the fair value to the market price. So what is the fair value? Here, what is the fair value? Fair value is not 75. 65 is the fair value. Why are people getting confused about such a simple question? Everybody should be clear. 65 is the fair value, is what you computed. Okay. So I want to make sure that the reason I'm going through all these logical steps is I want to make sure that you understand that there is nothing arbitrary going on. We are following the very same rule that we declared earlier, which is, what are we going to do? We are going to compute value versus price. We are in this box, value versus price box. So we are going to compute the fair value, and value means fair value. We are going to compute the fair value, and then what are we going to do? We are going to compare it to the price. Okay, now we've already computed the fair value is 65. Okay, and then we compare fair value to market price. Okay, and the market price in this case is greater or lesser? Is greater. The market price is 75 and the fair value is 65. So therefore our decision is sell. In the natural market we will be selling. Okay. So this answer which Bhola gave very quickly yesterday, that he is going to sell the Delhi sugar, which what we have gone through right now is actually the thinking process that must have gone through his head to arrive at that answer. Are you following now? Okay, because obviously as human beings we are able to think very quickly, and sometimes we don't think about all the logical steps that are involved in coming to that decision. Is this clear? Now this is how you would program it into a computer. If you had to program the logic into a computer, you would program it in this way. All the steps would be given because the computer doesn't know anything. Is this clear? Okay, now you've understood AFP principles. Okay, so the other thing that we need to learn at this stage is this term called classical riskless arbitrage. Okay, this is a term that we are going to now refer to as only as CRA. Okay, to avoid mentioning this big expression all the time. Okay, so just read CRA. What you have actually done, essentially what Bhola was proposing to do yesterday, is to ship the sugar from Patna, buy it in Patna instantaneously, buy it in Patna and then ship it across at the same moment, tie up the shipping arrangements, and then instantaneously at the same moment also sell to the Delhi dealer, okay, at 75 rupees and lock in a profit of 10 rupees. So what I'm saying is that what Bhola was proposing to do yesterday is he was actually engaging in or he was proposing to engage in classical riskless arbitrage. Okay, so now read the definition for a while. Please make sure, again, you understood the transaction, but you have to understand it theoretically, which means you need to know you need to know the keywords, you need to know exactly how the language is used, okay? Because many of you are very sloppy in the use of language. That is not acceptable for an MBA student. Okay, all right, guys, let's have a look at this. Just read this. The new term here is law of one price. We'll come to how the law of one price comes about, okay? Let's highlight some keywords. Instantaneous, riskless profit. Here risk we are going to define, we are going to qualify riskless, okay? By riskless, what do we mean? What does op risk stand for? Operational risk. Okay, so operational risk can remain it may actually happen that you've got the Delhi dealer on the phone and your partners in front of you has the Patna dealer on the phone, and just instantaneously in a millisecond you may do the transaction, but the communication link may break down at the other end. So these, even while executing CRA, there may be some of these operational type of risks. Okay, even later on, operational risk can remain in CRA. Okay, no remaining market risk, operational risk can remain. Okay, communication links may break down, or shipment in this example, because there's a 14-day delivery period, the shipment may go awry for some reason. Okay, shipment may be damage to the goods, or all kinds of risks are possible in shipment. Okay, shipment can go awry in some way or the other. All right, are you following what I'm saying? All kinds of problems can arise in the shipment. Okay, so so this can happen. So operational risk can remain. All right, credit risk also remains. Okay, because the Patna dealer, you have remember, transaction date is today, but the settlement date is T plus 14. All right, so you are buying from the Patna dealer, so you may have remitted the money to him. Okay, you may have made arrangements, but he may not ship. He may fail to deliver. That is a different thing from the operational risk. That something goes wrong with the shipment halfway through. All right, that's a different thing. That's operational risk. Okay, some damage to the goods or whatever. But the guy himself may be over smart. He may decide not to honor his contract, pocket your money. Then you have to go and sue him in court. Okay, so it's not an easy process. Now that's credit risk. Okay, so these problems can still remain. So when you do CRA, when we say, because typically when you look at a typical textbook definition of CRA, okay, you will not find these kinds of qualifications. Most of the textbook definitions will only say riskless profit. Okay, but they don't make a clear, they don't make the finer distinction between market risk, operational risk, credit risk. So you can see here that there is this example that you saw, okay, where you sell in Delhi at 75 and arrange to have it shipped from Patna and earn a 10 rupee profit. Okay, if everything goes okay, which is what normally happens, okay, you don't have manifestation of operational risk or credit risk every day in the markets. Okay, so you understand the difference between these types of risks? You remember these types of risks?
Yes, yes.
Market risk, operational risk, credit risk. Okay, okay, legal and regulatory risk. Okay, so one of the reasons we have these kinds of distinctions. Okay.
So what can be the legal risk?
Sorry.
So what can be the legal risk in this kind of risk?
In this case, the legal risk might be things like, if you don't pay the, later on you don't pay the GST or things like that. That would be an example, and later on you have to pay a fine for that because the other guy may not have done something that he was supposed to do legally. Those kind of transactions, or you don't pay the, now you don't have that interstate duties anymore with the new GST scheme. So those are the kinds of legal risks that might arise in this case. Okay, so the point to understand about CRA is that when we say riskless, we only mean that there is no remaining market risk. Okay, operational risk can remain, credit risk can also remain. Okay, but in general, operational risk and credit risk do not manifest every day in the business world. They happen from time to time. Okay, so it's a lumpy kind of distribution for these kinds of risks. But market risk is happening every day because prices are moving around all the time. All right. So in this case, if nothing goes wrong, there's no operational risk, operational problem with the shipment. There is no default by the other party. There's no credit risk. Okay, if nothing goes wrong on these fronts, then you have locked in a 10 rupee profit. Okay, so this is what riskless means, that instantaneously you lock in the 10 rupee profit, and which you'll be able to enjoy, assuming that no other type of risk creates a problem. Are you following what I'm saying?
Yes.
Okay, all right, so this is what is meant. So the term that you need to be aware of is CRA. What you have done in this case is that you have engaged in CRA. You sold in Delhi at 75 and created a synthetic equivalent long position. So in Delhi, your position is short. In the Delhi market, in the natural Delhi market, your position is short, and in the synthetic equivalent, your position is long. Are you following this? Now remember the position logic.
Yes.
Your concept of positions, long and short. Okay. So you went short in the Delhi market, so your position is short in the natural Delhi market, and your synthetic equivalent position is long. So remember, again, it seems very basic, but please remember these frameworks, because in more complicated situations, it will help you when you have the framework clear in your mind. You created a long position to offset a short position. Is everyone clear? Are you following? Okay. So this is what is meant by, it's important to understand what classical riskless arbitrage is, because, okay, why are we using this term, okay? Credit risk also remains in CRA. Credit risk does not necessarily mean that the credit risk will manifest itself. But you have to be aware that until the guy actually delivers 14 days later, theoretically he could default. That's what I mean by credit risk remains. That doesn't mean that he will default. Okay? Alright. So why is CRA important? Because important to distinguish between between CRA and other situations, okay, incorrectly described using the word. This is very common in the industry, so you have to be aware of this problem. Incorrectly described using the word arbitrage when the latter are not CRA. Are you able to follow what I'm writing here? That the reason I have made this, the reason we have created this concept, it actually exists in the market. If you say classical riskless arbitrage and you explain what you mean, people will understand. But there is a tendency in the industry to use the word arbitrage very loosely. Okay, people are not very careful. They use the word arbitrage loosely, and so they apply it to situations which are actually not. Which is why now it's important to define something called classical. The reason I'm using the word classical is kind of old. Okay, the old concept of arbitrage, which is there must be a locking in of a riskless profit. Okay, ideally without a capital outlay. Okay. Simultaneously selling and buying the same asset, okay, two different counterparties. Alright, this is the crux of classical riskless arbitrage. That is, you must be able to, assuming that no other type of risk manifests itself, your profit should be locked in, guaranteed. Okay, no confusion about it. Okay, so the problem that we have, so this, when you can do this, you call it CRA. Okay, why is it important to define CRA? Because you have lots of other, let's look at this situation. Have you guys heard of this term called merger arbitrage? No? You haven't heard of merger arbitrage? Okay, so what is merger arbitrage? Merger arbitrage is buying stocks of, you know, target and acquirer?
Yes, sir.
You understand target and acquirer? Okay. Buying stocks of, let's say, companies that are potential targets, okay, before, so the sentence is not very well constructed, but you'll know what I mean. Before merger, I'm not writing full English sentences, before merger is officially announced. Okay, so even after the merger is officially announced, there is a risk because the merger may not close, right? You're aware of regulatory hurdles in mergers,
Yes, sir.
right? Like AT&T, I think that is still being litigated. AT&T, Time Warner, the government of the US government has lost the first round, but they are going to go to the Supreme Court possibly, okay, on this. All right, maybe, or I don't know which stage it is in. They might go to a higher court. Okay, so there is litigation, so technically you can't really be sure that the merger will go through because they might win at the higher court. So there are legal and regulatory, so there are two things in mergers. One is the official announcement of the merger. And then even after that, it's not 100% sure because the regulators may clamp down. They may forbid that merger, all right? So therefore, there are two levels of uncertainty. Now what these guys do, the guys who do merger arbitrage, is a very old business on Wall Street. Okay, so you had people like Robert Rubin, who was a US Treasury Secretary from, he was ex-Goldman Sachs. He was in merger arbitrage. He was heading the merger arbitrage department. So what merger arbitrage is doing is, Let's say we assume that, let's say some company is going to be bought up, okay? Let's say you can just target, let's say before the Idea versus Vodafone merger was announced, okay? Let's say you had a hunch based on what was happening in the industry. Let's say you had a hunch that Idea would be taken over. Okay, let's say you had a hunch. Nothing has come out officially. These are just rumors in the market, and you do your own analysis and you think that this stock is maybe a little undervalued. And if Vodafone takes over this company, then they will get a lot of synergistic benefits and things like that. So you basically have a suspicion that Idea might be taken over. Nothing has come out officially. So now you go and accumulate a big chunk of Idea stock in the hope that once the merger is announced, obviously the merger will typically have to be at a premium to the market price. You remember that? When you look at the real life mergers, most of them have to be announced at if the market price is $32, you can't just expect people to sell it at 30, the shareholders to sell at 32. You'll have to offer something like 65 or something like that, okay, or 55 or something like that. Some solid premium to the market price. Usually it's around at least a 20% premium to the market price, okay. So therefore you know that if the merger actually is announced, then you'll make a big profit because the stock price will jump. Are you following the logic?
Yes, sir.
Okay. So this business is called, so you're learning something new about mergers as well. So this is actually a kind of speculative activity, okay, carried out by the banks and investment banks. So this activity is called merger arbitrage. It is also called risk arbitrage. Risk arbitrage, you can see already, is a kind of an oxymoron. This is like a tall short, okay, it's like a tall short person. Okay, or it is also called risk arbitrage. Okay, or sometimes people might just say risk arb. Instead of using the full word arbitrage, they might just say risk arb. So if somebody tells you that I work in the risk arb department at Morgan Stanley, what that means is this is what he does for a living. He goes around hunting for companies which he thinks might get bought up, might become targets in potential mergers. Then he will accumulate the stocks. They have some capital at their disposal. They will start accumulating those stocks in the hope that the official merger is announced, and then the stock will jump, and then they'll sell it and make a profit. Are you following this logic? This is the merger arbitrage business, also called risk arb or risk arbitrage. Okay, now tell me, is this CRA? Himani, where is the mic? Give her the mic. Does this seem like CRA to you?
Yes.
1 minute, I want to know Himani's answer. You understood? Now make sure that you guys, I have explained merger arbitrage. Classical risk, you understood what CRA is? Okay, what Bola was proposing yesterday? Right, now my question to you is merger arbitrage, you notice that the industry is using the word arbitrage, okay? So my question to you is merger arb CRA? Yes? Okay. But what? Why is it yes? Why is it CRA? What is the hallmark of CRA? Okay, 1 minute. Who else agrees with Himani? I think you also agree that it is CRA.
So it is similar to.
No, not similar. I'm saying, is it the same as CRA?
Yes.
Same means equivalent, exact, identical, no similar.
Yes.
We can say it is.
Yes.
It is CRA. You would call it CRA?
Yes.
You also would call it CRA? Anybody else? So we have so far, the question is clear? Is the question clear to everybody? We have described what merger arbitrage is. Now my question is merger arbitrage CRA? You can read the definition of CRA here. Yes, anybody else? Nobody else has any view? Either yes, no, agree, disagree, nothing, no view. What is not clear here? Classic CRA is clear. You understood what is meant by CRA. Okay, CRA is very important to understand because you need to be aware of this important type of transaction because it can be used as a valuation principle. Okay, this logic, the creation of a synthetic equivalent and the cost of creating that. So CRA is very important to understand, and also merger arbitrage is a transaction that you should understand what these people do in merger arb departments. Okay. So now my question, CRA, anybody else? Anybody with a strong view? Yes, no? Question is merger arb an example of CRA? Anybody? No one? Now, it should be very simple. I mean, if I hold a mango in one hand and an apple in one hand, I'm asking you is a mango equivalent to an apple? You should be able to answer. The answer is no. because you know what a mango is and you know what an apple is. Okay. So that means if you are not able to answer that, that means either you don't know what CRA is or you don't know what a merger arb is, or both. Where is the problem? Okay. Yes.
But I think they are not same because
Use the mic. Okay, so you have a different view. You're saying that merger arb is not CRA.
because
Why?
the CRA it is written that there is riskless profit. But in the merger acquisition, they can have the loss also after taking the shares of the companies. If they are taking after merger, by chance they can get the loss also.
How would they have a loss?
So, if
Well, let him finish. Let him finish.
so they can have the loss if the
Be quiet, guys. Everybody else should be quiet. Yes.
if the company is the share price is same, or after the merger the merging company is occurring the losses. Like the reason for which the merger has taken place has not been successful, so they can get the
Okay, so the rationale for the merger. Okay, so I think anybody else wants to answer? That's it? Nobody else has a view? Okay, fine. So Tanuj's answer is correct, but your and the reason you gave is also potentially correct. I mean, it's not the best possible reason, because see, if you understand merger arbitrage, these guys are not going to wait. What he's saying is after the merger, like the TXU merger, after the merged company might go bankrupt because the deal doesn't work out as planned. Okay, you don't get the synergies that you expected, like what happened at AOL, Time Warner, and all that in the 90s stock market bubble. Okay, but what merger up guys are not going to wait around for so long. What they are going to do is, as soon as the merger is announced, okay, either that when the stock price will pop, as soon as the merger is announced, the stock price will pop a little bit. It may not go to the merger price. Okay, if the merger price is 20% higher than the market price, it may not go directly to the merger price because there are some risks. Even though the official announcement is, remember I told you the risks of regulatory risk, the merger may not get approved. So that's why in many cases you'll see that the target, maybe the share price is announced at, the merger will go through at $65 a share. But before the merger, maybe the price was trading at say 35. Okay. Now after the merger is announced, it will shoot up from 35, but it may not go all the way to 65. It may go to about 62 or something, because there's some risk that 62-65 difference is reflecting the risk that the merger may not be approved. Okay. What happened? Why is everybody looking? Are you following? Okay. So I need to see engagement from you guys. I need to see you guys looking at me and nodding aggressively. You know, so that I get some kind of affirmation that whatever I'm teaching, you're able to register. I mean, it's registering in your head, right? So therefore, merger arbitrage guys are not going to wait around for that long usually. What they will do is, as soon as the price pops, some of them will sell out and some of them might tender into the actual final closing. Okay. Usually they form a block, they have some little more negotiating power. So the acquiring company has to deal with these. This is one of the problems in M&As. That the acquiring, because risk arb has become so popular, that one of the things that the target company has to deal with is these groups of, there's like a cartel of these merger arb guys who are holding huge chunks of stock. Okay, and they are now trying to arm twist the acquirer for a higher price. Okay, so all this stuff is also being played. But you can think of the simplest possible way for a merger arb guy to make a profit is that he buys the stock before the merger is announced. Okay, when nobody knows anything. And he buys the stock, and then once the merger is announced, there's a pop in the stock price. Okay, he shoots up 15 to 18%, and then he sells into that and makes a profit. But Tanuj is correct in pointing out that merger arb is not CRA, because it's not a riskless profit. You can lose money in many ways. If the merger is not announced, then the target companies, the potential target companies, if there's no announcement, okay, let's say you bought Idea in the hope that Vodafone will bid for it. But if the Vodafone bid never comes through, there's no official announcement, then eventually the Idea price might start sliding down, because you're anyway saying that company is not very viable on its own. Are you following the logic?
Yes, sir.
So there is a risk in merger arb, because you're actually taking an open long position, just a straight long position, and you're riding on it. So it is not CRA, because CRA means instantaneous riskless earning, or let's say locking in. maybe earning, better to use locking in. You understand what is meant by locking in? You understand what is meant by locking in?
Yes.
Okay, so then if you, so some people don't understand. So locking in means in this example, okay, if you see here, in this example, what are we doing? The cost of the synthetic position is 65, the cost of the synthetic long position is 65, and we can see a choice price at 75 in the Delhi market, in the natural market. So we sell here, we create a natural short position and we offset it with a synthetic long position, and we have locked in a 10 rupee profit. Locked in the sense that I have not yet earned the profit, I will earn it only after 14 days. Assuming nothing goes wrong, okay? After the delivery happens, then the sugar positions will cancel out, long against short, and I will have a outflow of 75 rupees when I pay in Delhi, and when the Patna fellow pay, and to the Patna fellow, I will have an inflow in Delhi, okay? I'll have an inflow in Delhi, and in Patna, the dealer, I'll have to pay him 65 rupees. So the actual realization of the profit is on the settlement date. Is everyone clear about this?
Yes.
Okay, what is the problem here? Why are you looking back?
I'm asking for water.
No, you should not be asking for water. You should ask for, you should, I didn't want to open the sheet.
Sir, I have baat hi nahi kar.
You ask for water, you raise your hand, and then you ask me. Because I don't know what you're asking for. And I'm going to deduct marks for Sahil also, because earlier I saw him looking, I didn't want to open the sheet at that time. I saw him communicating with somebody.
This is September 18th.
We may not even get a chance to give you an opportunity to earn positive points. I don't know how I'm going to deal with these scores. We'll figure out. One sec. This will go. No, you were communicating with somebody there. I don't know who it was. Maybe Shivani or somebody. I saw it. I didn't want to open the sheet at that time. Talking is not. He was also not talking. I'm not interested in who is talking, because I can't even hear whether you're talking or not. I'm just interested in any kind of behavior, which is any kind of communication with anybody else.
The communication was not even verbal or non-verbal.
No, it was non-verbal. It was very much non-verbal. It may not have been verbal, but it is non-verbal. Okay. So I should not have to do this. If you need water, you raise your hand, just like an exam. Okay. Because we don't do it this way, then everything will collapse. As it is, people are all half dead. Everybody's, I don't know where you guys are mentally. Okay. So if you don't follow, it is your responsibility to ask me questions. If you don't follow anything I'm saying, okay. You don't have a right to just switch off and go off on your own. You go into samadhi. So, okay, what were we saying?
Lock in.
Lock in the profit. So what I mean by locking in the profit means that I have not earned the profit. So in fact, I should change this definition. Instead of saying earning, I should only say act of locking in. Because in many cases, you don't actually earn it immediately. Okay, only in a cash transaction, and even then you have to wait for the settlement to go through. So we should not say earning, we should say locking in. By locking in, now you understand what is locking in? In that I have locked in, I have done all the, so remember transaction date, what happens is the terms of the contract, the contractual liabilities of the parties are crystallized on the transaction date. How did we discuss transaction date versus settlement dates? Right? So every transaction in a financial market is a contract to exchange assets, right? So the contractual liabilities to exchange the assets is formed up on the transaction date itself. Once the contract is formed, you have a liability to perform the contract. But the actual delivery and the actual exchange of assets will happen on the settlement date. Okay? So until the actual settlement date happens, you have not really earned that profit, okay, in the cash sense. You have not earned it, but you have locked it in, assuming that no mess up happens on credit risk or operational risk, then you will earn it. Is this clear? This is what is meant by locking in. So CRA is not, merger arb is not CRA, right? Okay, so merger arb is not CRA. Is everyone clear about that now?
Yes, sir.
Because what you're doing in merger arb is you're just buying the shares of Idea when you just have a suspicion that Vodafone might take over this company, but nothing officially has been announced. So who knows? I mean, maybe eventually the official announcement may not come. All right, so if it doesn't come, the stock price may go down and you have already gone long. So merger arb is actually a straight speculative long position in the potential target company. Straight, that's what it is. Okay, so it is not CRA because there is a lot of market risk that still remains. Okay, that is the way to talk about it, that it will still have market risk that remains. Is everyone clear about this?
Yes, there are two reasons behind it. First is that it's not instantaneous.
Yeah, and it's not, you're not, yeah.
There is a risk.
Yeah, and market risk remains. You have instantaneous riskless profit means you have no remaining market. Like after doing this transaction, if you're doing a true CRA transaction, like what Bola had proposed yesterday in Delhi versus Patna Sugar, what he had proposed was a true CRA transaction, because once you complete that transaction, no market risk remains. But in merger arb, you have remaining market risk because you're just sitting on a straight long position. That's all. Okay, so that's what it is. Okay, so that's why I'm making this distinction. It's important to understand this very clearly what exactly CRA is, because you will see many other examples. I'll give you some other examples also later, but this is one example: merger arbitrage, where the market is using the word arbitrage, but this is not really CRA. So it is actually, according to me, an irresponsible use of the word arbitrage, but the market does this all the time. Okay, because they don't really think about exact terminology and consistency and all these aspects. They just coin something and just move on. Okay, all right. So now this is clear now. So we have understood what CRA is. Okay, now when I say that all I'm saying here is okay. Now you notice that here what I've done is I'm going to remove futures from here. There is a little bit of very marginal risk in futures, so we should not use futures. I'm just going to use FX cross rates. These are the pure examples of CRA. So AFV, properly so called, essentially means that where you can actually do the CRA. What you have done here, let's understand this. And what we are saying is that the option models, all option valuation models, they are actually they pretend to use AFV principles, but these are actually not cases of AFV truly, because the CRA cannot be done. Okay, what do I mean by CRA cannot be done? Here's one example. Okay, so it is not possible to perform CRA in these situations. Okay, so let me write it here, then I'll explain what I mean. So here the actual market price can't be forced to converge to the fair value using, which is calculated AFP fair value. Okay, when I say AFP fair value, means fair value computed using AFP principles. Okay, so let me just explain here a little bit one more thing which we can highlight here, which is so AFP, just understand at this page, because essentially you cannot force the actual market price to converge to the fair value, okay, using this principle. Now let me show you what I mean by that. This is also an important thing to understand. Okay, now here, go back to this example. Right, now what is Bola doing? He's taking, initially we said he's going to deal in 10 kilos of sugar. But let's assume that he is very greedy and he sees this opportunity to make lots of money. Okay, so he says, why should I deal in 10 kilos? Let me deal in 100 quintals. Okay, let me deal in 100 quintals or maybe even 500 quintals, as big a size as possible. Okay, because anyway I'm locking in a riskless profit. So let me deal in like 500 quintals or something. So imagine that. So what is he doing in the Delhi market? Is he buying or selling? Selling. Okay. So now what is happening when Bola comes in to sell 500 quintals? What is that creating? Excess demand or excess supply?
Excess supply.
Excess supply. Is this clear? Excess supply in the Delhi market. And ceteris paribus, when excess supply hits the market, what happens to the price? Price falls. Okay, so what you see is a tendency that the price will tend to move lower from 75. Okay, so after seeing Bola, now Cheda will also get excited and he will also come in with his 500 quintals. So more and more people get into the game and they start selling. They're creating excess supply. Excess supply means ceteris paribus, price must fall. Okay. So therefore, there is a downward pressure on Delhi prices. Are you following the logic?
Yes,
okay. There's a downward pressure. Now, similarly, what is happening in Patna? Bola has to buy in Patna. Chedda also has to buy in Patna. So everybody who is selling in Delhi is also buying in Patna. So there is excess demand in the Patna market. So what will happen to the price? It will rise. Okay. So what you see is eventually there is going to be a convergence. Can you see between the two prices?
Yes, sir.
Okay. So whenever you have a situation where it is possible to execute CRA, executing CRA in this situation means you should be able to lock in instantaneously, buy from this guy, arrange the shipping and sell to this guy. Okay. And you just have only operation, no market risk is left in the transaction. Okay, so if everybody starts to, whenever there's such an opportunity to do true CRA, this is real CRA. Okay, classical riskless arbitrage can be done. Okay, we can just call it CRA. That means true CRA. I mean, really can do the arbitrage. Okay, and so when this happens, what will happen is that there will be upward pressure on prices in Patna, and so the prices will tend to converge. Okay, it will tend to converge. So eventually the arbitrage will disappear. Can you see that?
Yes.
Eventually the arbitrage will disappear. So if it comes anywhere, even if it comes to 65, now there's no more profit. If the Delhi price drops to 65, in the meantime, this would also have risen a little bit. Okay, so therefore already the profit will disappear. Are you following the logic?
Yes, sir.
Okay, what will happen? Okay, so this is why this is called the law of one price. The classical riskless arbitrage transaction which you do, okay, this essentially ensures that this law will always prevail. Okay, whenever it is possible to do this CRA, okay, whenever it is actually possible to do this CRA, the law of one price will prevail. Okay, this is an important term in economics. So this is what, when you hear this term, law of one price, this is what it means, that the same asset cannot have two different prices in two markets which can be connected to each other in some way. Okay, but connected to each other means you can actually talk to people in Patna and you can arrange the shipping from Patna to Delhi. Okay, so if these two markets can be connected in some way, okay, effectively to make sure that CRA is possible, then you cannot have two different prices like 45 and 75 prevailing in the two different markets. Eventually the prices will converge together. Is this clear?
Yes.
This is what is meant by law of one price. Ishan, are you following? Okay. So now therefore this is what is meant by the law of one price. So eventually it will make the prices converge. Now see the problems. Okay, what do I mean by, why do I keep on saying when you can actually do the CRA? Actually do the CRA means there is some execution to be done here. You need to call up the guy, buy from him, you need to send to the Delhi dealer, you need to arrange the shipping, and everything has to go smoothly. That means the delivery has to go smoothly. Okay, so now here the problem is, we said here there is no border restrictions on the trade. Okay, now suddenly if we say that there is a ban on interstate trade, now if we put a ban on interstate trade, now what happens? Can you do the CRA?
No.
You can't do the CRA because now the markets are no longer connected. because you cannot ship the sugar from there to here. Okay, so we are giving this example as a crude kind of example, but in real life, when you look at possibilities of doing CRA in potentially connected markets, you have to basically think in this manner. Is there any kind of obstacle to my executing the CRA? Okay, there may be some restrictions on borrowing. The government may have put restrictions on borrowing against bonds, or maybe there's a capital control problem. You can't trade in currencies. Okay, so you have to, in real life, what you have to look at is more complicated examples, but essentially what your brain is asking is there any kind of obstacle to my executing the CRA smoothly? Are you following the logic?
Yes.
Clear? Okay, so is there any kind of restriction on obstruction to my following the executing the CRA? If you have this, then what happens is CRA breaks down. CRA breakdown. Okay, let me call it breaks down. CRA breaks down. Okay, so now what happens is, if you go back to this question number 2, you were trying to see whether it is possible to get a AFB price. Okay, whether it's possible to get an AFB price for Delhi sugar. Now earlier the answer to that question was correct, yes. Okay, there is a true fair value using AFB because you could have executed the arbitrage. Now that we have put a ban on interstate trade, now the answer to that question is no. This is clear? Now you can't actually find out an AFB fair value because the arbitrage cannot be executed. Okay, this is clear?
Yes, sir.
Because you have put up obstruction. So what we mean essentially by AFB is, it is arbitrage free valuation. Now if you go back to the earlier situation where there was no ban, okay, when there was no ban, when you were allowed to trade freely, then you were able to execute the CRA. So what you were saying is AFB price, the AFB price in Delhi is 65. The fair value using AFB principles is 65. Okay. Why do we say fair value using AFB principles? Because that at the fair value of 65, okay, there is no possibility of arbitrage. If the price was equal to the fair value of 65, then there is no possibility of arbitrage. Is that clear?
Yes, sir.
Because the price is equal to the fair value.
Yes, sir.
Time up.
Yes, sir.
Good Lord. Okay, so let me 1 minute. I don't think it's time up yet. 1 minute.
आज के मिला के 3 minutes हो गए.
Okay, guys. All right, fine. But have you understood what we discussed? These are very important valuation principles. Okay. At least we should make sure that, I don't know how the time flies in this class.